Welcome to this video on the RBI's latest monetary policy update. Let's start. The central bank has cut the repo rate by 25 basis points to now 5.25%, while the SDF is now at 5% and the MSF and the bank rate is at 5.5%. The policy stance remains neutral. Overall, the tone is optimistic, with RBI signaling confidence in the India's economic momentum. RBI has revised India's GDP growth outlook forward. FY26 growth is now projected at 7.3%, with quarterly growth estimates ranging from 6.5% to 7%. Notably, quarter 2 GDP touched 8.2%, the highest in 6 quarters. The governor described the current period as a Goldilocks phase, strong growth alongside easing inflation. Growth continues to be supported by several strong fundamentals. Domestic demand remains resilient, industries and services are performing well, tax structures are becoming more efficient, and government capex is front loaded. Agriculture benefits from strong crop yields, manufacturing is picking up, corporate balance sheets are healthy, and private investment is accelerating. Even services export remains strong with ongoing trade negotiations. Despite strong growth drivers, some challenges still persist. Urban demand recovery is slower than usual and compared to the rural, and merchandise exports remain weak due to the global uncertainties. On inflation, the outlook is much more positive. FY26 inflation is revised down to 3.7%, while CPI has fallen to its lowest level since 2019, mainly due to the corrections in the food inflation. Core inflation is stable, and although gold contributes about 50 basis points to this, overall disinflation has been rapid. Looking at the inflation forecast, full year CPI is projected at 2% with gradual normalization expected in the next 2 quarters, and the rate cut is largely driven by the favorable inflation trends. Both headline and core readings suggest a stable pricing environment. And to maintain liquidity, RBI has announced a 1 lakh crore OMO purchase and a 3-year USD INR swap worth $5 billion scheduled for December. On broader macro indicators, India's current account deficit has narrowed significantly, FDI inflows remain strong, and Forex reserves stand at $686 billion, enough for more than 11 months of imports. The GSEC yields remain stable, indicating calm market conditions, and the next RBI monetary policy meeting is scheduled for February 4th to February 6th of next year, 2026. That's all for this quick update on the RBI monetary policy. Thank you for watching.